Well, thank you for having me. Good to be with all of you and good to have the opportunity to speak, if only remotely, on some of the innovative revenue models and options that states are considering. Some of which I think have a lot of potential, some of which come with some significant concerns, and maybe a few are in between, depending on where you land on certain issues. But certainly things that all of us are going to be considering a lot more. And some of them even deal with the fact that we are working remotely, and so many people are working remotely. Now, I'm working remotely today. I'm basically back in the office most days now, and a lot of people will be, but clearly our economy is changing and tax codes are going to change with it. So really, for the most part, I want to hit upon four different areas where a lot of states are considering new revenue models right now. One of those is cannabis taxation, where there's now 18 states that have legalized. That's up 9 from a year ago, and we'll see more. One, sports betting, where now 30 states in DC have legalized, and more are clearly on the horizon. And then two, I want to spend more time on our digital taxes. There's a variety of different ones. Digital advertising has been the primary area of focus, but also data taxes and social media taxes. And then just the question of how states tax remote work and what states do surrounding the questions of attracting remote workers and taxing some of that activity. So let's start, if we could, on sports betting as one of the simpler ones I'm going to spend a little less time on. Not that this is truly simple, but 30 states have done it. There are some models out there. Clearly, this is a multi-billion-dollar industry. In 2020, there was more than $21 billion wagered in states that had legal sports betting, and only about 15 states had markets that were operative at that time. So we're going to see a lot more revenue coming in this. But the question has been really ones of design. I think most states are moving in the direction of taxing. We may have a few states that hold out for a few more years, but this is coming down to the pike most states. Now, most of the rates that have been imposed are in the low teens. Of the 11 states that moved on this just over the last year, only 2 of them have rates above 15%. Now, a few of the states that moved on this early on have much higher rates. Delaware, Pennsylvania, a few other states, New Jersey, have significantly higher rates approaching 50%. And we're not seeing most other states follow them. New Jersey was in a somewhat unusual position with Atlantic City and being able to build on some of that infrastructure. Pennsylvania has a high rate and I think has struggled a little to have a foothold gained in the online sports betting. They do have a number of casinos in state. Most states seem to have settled on the idea of low double digits, low teens taxation, with the idea that that is about the appropriate point at which you can capture a significant amount of revenue while legalizing this market and mostly counteracting the underground market, because obviously there's still a significant underground sports book. Sports betting taxes are almost always levied as a percentage of the value of the adjusted revenue, basically revenue minus winnings. It's one of the few cases in excise taxation where price-based or ad valorem excise tax is the appropriate approach, because it's properly internalizing those negative externalities. When we think about excise taxes, there's a couple of things you can be doing with those. You can be focused on the idea of internalizing externalities, taking those public costs and the social costs and internalizing them, or you can have a user pays system. There's not a lot of user pays in something like gambling, sports betting, but there are social costs associated with it and enforcement costs. And the amount wagered is probably the best proxy for the harm associated with gaming. It's important to remember that this is a modest revenue source and probably not a sustainable one for large general spending priorities, but it is an area where a lot of states see an opportunity to take currently a black and gray market and make it a legal market with proper regulations and generate revenue, because certainly this betting is happening one way or the other. And we've seen a lot of states jumping on that bandwagon. I think most will probably get there soon. Cannabis taxation has been a little slower, but it's also way more complex. It's a new area for taxation. It's now legalized in, I believe, 18 states. That's up 9 from a year ago. And states have designed different excise tax systems for recreational marijuana. There's not been one approach. Most of these approaches have been based on price, also an ad valorem tax. But sometimes you also see taxes based on weight or THC content or some combination. Here, I think that most states have been getting this wrong. That price is the wrong use. That's the wrong base for the tax for a variety of reasons. And in fact, I think it's going to come back and haunt some states that have adopted that, and we might see some revisions. Because right now, of course, prices of marijuana are fairly high. Marijuana is still a scheduled drug at the federal level, and that has implications for the market. You can't have interstate sales of marijuana. Banking is still difficult. There's no federal tax deductions for the expenses associated with marijuana. If we had legal marijuana markets, if federal government were to adopt any of the legislation that's been proposed in recent years and legalize marijuana, you would likely see a far more competitive national market with much lower prices. So if the MORE Act or something else like that passes, retail prices are going to plummet. And then the states that have adopted tax rates based on the current high prices for marijuana are going to see those ad valorem taxes bring in far less revenue than they're seeing right now. The other thing here, though, is that it's not really an obvious base for taxation. Taxing by price affects consumer choice and product quality. It can incentivize down trading, which really has nothing to do with harm reduction, nothing to do with the externalities. Ad valorem taxes can also lead to tax pyramiding, and that can be even more true if there's multi-state markets where maybe one state is taxing at the wholesale level and another state is taxing at the retail level, and both of them end up taxing the same transaction to a significant degree. But again, we're not really capturing anything here other than price, and potency makes a big difference if we care about the externalities. The type of product makes a difference. So specific taxes are generally more stable, and they're generally the way that we look at excise taxes, but that's not been a common approach with marijuana. And for some purposes, that's because of the complexity associated with it. They're not simple because there's multiple different weight categories that would have to be defined. Weight of trim can't be compared to the weight of flour, for instance. These are very different products. So you have to address these issues. There is an advantage in weight-based taxes for a lot of the businesses currently in this space, which is if you're vertically integrated, if you're doing some of the cultivation and production and sale, if you have an ad valorem tax at wholesale, you have to somehow figure out what the wholesale price is. And that's actually more complex than you might think. There's estimates that go into this. They're imperfect. You get rid of this if you have specific taxes that are based on weight or some other measurable aspect. You don't need that artificial valuation for vertically integrated companies. Potency taxes, though, are better than weight-based taxes because they address the externalities best. More potent products are more expensive. They have more social costs, and it makes sense that you could put more taxes on them. The challenge is the measurement. There are a couple of ways that states have devised to try to measure or require companies involved in this space to measure THC content, but it's still a developing field, and most states haven't felt very comfortable with it. Even when state labs run these things, I think they sometimes get somewhat conflicting results, and obviously that's an expensive process. A lot of these products are not standardized in ways that yet allow THC to be used across the board. It's easier in some product lines, a lot of the consumables, than it is in others. But some sort of potency and weight-based tax defined by THC level is probably the best short-term solution for lawmakers. And that's increasingly what we're seeing in the newest versions of this. I mean, that's what we've seen Connecticut moving towards. That's what we've seen in New York, where they're moving away from just ad valorem and with all the concerns that has, and moving towards some sort of interim potency and weight-based tax. I think that's the right approach, remembering, of course, that you are competing with a very strongly established illegal market, and therefore rate competitiveness matters as well. And just again, bearing in mind that obviously you have the potential for a much more competitive market in the coming years. A meaningful source of revenue, certainly, again, not necessarily earth-shattering. We do on our website have some analyses of what it would mean revenue-wise, looking at Colorado and a few other states as a benchmark, what states could likely anticipate based on sort of ordinary rates in revenue, because sometimes I think you've seen some unduly optimistic revenue estimates. So we have some benchmarks that you can look at to see what a state might be able to generate with a sort of standard marijuana tax. Something I want to spend a lot more time on, though, because it is this emerging issue that everyone's talking about, is taxing digital advertising, digital services, lots of different ways that this has been proposed. So you have the traditional, I say traditional, all of this is new. You have the digital advertising tax model that Maryland is running with, postponed for now, but they did adopt legislation, and that is a tax on gross revenue from digital advertising in state. In their case, with tax rates based on global platform revenues. You also have a variant of this, social media taxes. It's basically the same thing. It's digital advertising on social media platforms, just limited to them. And then some of the proposals have added a per account fee as well, like $1 per every account that is in the state. And then there's data taxes, and that can either be on the possession or the sale of consumer data. And 9 states have proposed some version of these this year. None of them have been adopted this year. Maryland overrode a governor's veto earlier this year, but that is the only action on these. We have a lot of wait and see because Maryland is facing pretty serious legal challenges. They're also facing an administrative morass that they are trying to wade through. So I wanted to address some of the justifications that have arisen for these taxes, some of the rationales associated with them, talk through that, and then talk through some of the challenges if a state were to go this route. Firstly, there's the question of why, because obviously there's a lot of business activities that we don't put special excise taxes on, practically all of them. So why this one? And a few different rationales have been advanced. One of them is the idea that there's some sort of loophole, that digital advertising isn't being taxed in state, the profits are somehow evading tax. And this largely arose from looking at the European model, where you have multiple countries and you don't have sourcing rules and apportionment like we do in the United States. And therefore, under their value-added tax structure, without those sourcing rules, it often was going untaxed. They've largely addressed that. But there was a lot of early misunderstanding, I think, that the international experience was similar here. But of course, international tax regimes lack economic nexus, they lack market sourcing, they lack a lot of the things that we have in the States that address these digital tax models. So that was one reason. Another reason why this was argued for was the idea that, frankly, just tech companies have a lot of money and we should tax them because there's money there, or that targeted advertising is undesirable and should be penalized. And that was one of the strong intellectual rationales for these proposals initially, but it's not one that's been advanced by most policymakers themselves, because I think for the most part, it's been seen as a revenue source. There's been a desire to generate significant revenue from it, not to put that particular business model out of business. And then there's a punitive approach. I think this has been more on the right than on the left, but especially with the social media taxes, a distaste for companies, say, engaging in content moderation policies, and an idea that you could use the tax code to punish them for that activity. Now, obviously, that's pretty non-neutral in its approach. It's also, I would argue, not an appropriate use of the tax code to target particular businesses based on political decisions or rationales, but certainly that has been out there. There are a number of problems with this whole idea, though. Firstly, even though the taxes are designed as being imposed on large platforms, we're talking, the Googles and the Facebooks of the world, and they would be the legal remitters of these taxes in most cases. Most of the burden is in state. There's every reason to believe that most of these costs will be passed on to the advertisers themselves, and the majority of advertising that is targeted at individuals in a state is in fact by in-state businesses or businesses with a significant presence in the state for kind of obvious reasons. So, even though the tax might be on Google, ultimately much of it is being paid by the local restaurant owner down the street that is trying to advertise on social media. And a lot of states, I think, that hasn't been their intent, but it is the reality of these taxes. There was a study in the French digital advertising tax market they found that 55% of the advertising costs were passed on to the consumers, and most of the rest was borne by the businesses without being passed on, but almost none of it was incurred by the platforms themselves. The US system is different. I'm not sure that you would have that breakdown of how much of it goes to consumers, but nonetheless, you would expect that this would largely fall on consumers and in-state businesses, not on the out-of-state platforms to any significant degree. More substantially, though, there are some major legal issues, some hurdles that states would struggle to clear. We have the Permanent Internet Tax Freedom Act, which prohibits imposing discriminatory taxes on electronic commerce. And discriminatory generally means it's not generally imposed. It's a tax that's falling only on the electronic commerce and not on similar transactions accomplished by other means. So if you're taxing all advertising in the exact same way, then you could tax the electronic. But if you are just taxing digital advertising, that would seem to be a facial violation of the Permanent Internet Tax Freedom Act. And in fact, there's 2 lawsuits pending in Maryland right now arguing just that thing. There's also some constitutional questions. These are always more complex and courts don't love taking them up. But you have the question of whether these are both internally and externally consistent under the Dormant Commerce Clause of the United States Constitution. Maryland's approach probably fails the so-called external consistency test. It's taking into account activities entirely out of the state, revenues from advertisers that aren't in state. But you could solve that problem. Maryland has a very weird tax structure. You could create a digital advertising tax that is only focused on in-state advertising. That would still, however, have due process and internal consistency challenges. It is really hard to define advertising served in state. And if you get it wrong, you have a constitutional claim. Internal consistency tests require that if every state adopted the same system, then you would not have double taxation. Now, every state doesn't have to adopt the same system, but if each of them did adopt the identical system, you would not yield double taxation. None of the proposals out there yet come close to achieving that. They struggle with having consistent, meaningful definitions. A lot of this is left up to tax administrators because defining when an ad is truly served in state, when it's seen in state, where an IP address is actually located, how you do geofencing, this is difficult, somewhat arbitrary determinations. Also potentially discriminatory in the sense that most of these are going to be targeting, at least in the legal incidents, the large out-of-state facilitators or advertising platforms. So, the constitutional limitations on imposing taxes that have legal incidents almost exclusively out of state are going to come into play. But then even if states somehow cleared all of these hurdles, the biggest one being the Permanent Internet Tax Freedom Act, you have to figure out how in the world you implement this. How do you apportion it? How do you define advertising? Does voice over IP services for telephony, does that count? Sponsored content? Streaming of terrestrial broadcasts online, email newsletters. There's so many different things that states have struggled with as they've thought through this that everyone sort of pumped the brakes since Maryland. And then you have data tax ideas. So New York was sort of a leader in thinking this through. The idea being that you would have some sort of tax. It could be functions of property tax. It could be a transaction tax. The New York one is essentially on the value of consumer data on New Yorkers that is owned by a company. So you have to assess that in some ways. You have to know whether that is associated with a person in state, which a lot of companies don't have that information. And fascinatingly, it's not just, say, your big platforms and tech companies. It's any company of sufficient size, which isn't a high threshold, that has consumer data. So grocery stores fall under this. A grocery store chain that has a loyalty program, which obviously has consumer data, that would be subject to a data tax. Any business that is maintaining client files, they exempt just having billing addresses. But if you have anything on a client or a customer or really anyone, general consumer, beyond a name and billing address, which almost anyone is going to have, then you have consumer data that somehow needs to be valued and assessed. No one really has a sense yet how to do that, but that has been the proposal in these states. or this has consequences. Consumers might end up paying more, not just because businesses could be able to pass along some share of these advertising costs, but also because the taxes could change their own access to online services. If currently an advertising supported model is less profitable under a tax like this, then more of the internet might go behind a paywall. And then you got to ask, would people be better off if it became too expensive or too much of a hassle for retailers to offer loyalty cards or member perks? Or if social media companies were taxed on both their revenue generating ad content and per account, it might make sense for them to restrict account creation or maybe even adopt subscription fees, or innovation might be reduced in that space. It's a really strange set of taxes. And fundamentally, it's tax pyramiding. It's an area where we would be taxing a business input, a business activity, without taxing, not just taxing the profits, because that's of course how we generally tax. And social media companies, digital advertising platforms, all of these companies are subject to corporate income tax. This activity is taxed on the profits, where you sometimes have an area where a state might not be getting what it sees as its fair share, would be based on sourcing rules. Increasingly, states source service income where the benefits received, where the market is. And if that's how you source service income, then if you have digital advertising in state, if you have this activity in state, it's subject to your corporate income tax. If you do it on the cost of performance or where the income producing activity takes place, then you probably don't. And just as states have increasingly shifted to single sales factor and focused really on the sales aspect, they have also aligned the services side, since goods are always going to be sourced for corporate tax purposes where the destination is. It's a destination source tax regime. We're seeing that destination sourcing as well increasingly for services, but not every state's there. So if a state is saying, well, wait a minute, there's digital advertising in our state and the profits aren't flowing to us, we're not able to tax that, there is a solution, and that is to adjust your sourcing rules. It is not to create a new tax on one particular type of activity. So this is one area where there's been a lot of talk lately about this being a new revenue source, but I would encourage extreme caution. The litigation, I think it has a very high chance of succeeding. This is administratively complex. There's not a good economic case for it. And then finally, I know I'm probably running up on time a little, but I want to talk about what it means to tax in the era of remote work, because remote work changes so much. Obviously, as people may be working for a company that is located in one state and actually working out of their home in another, or traveling more frequently, there are withholding tax questions, withholding in multiple states. On the business side, you got withholding. You have that question of sourcing of service income. If you have service performing personnel who normally were at your office, but now are located in other states, it's not just an apportionment question of some tiny fraction of tax in those states because you now have payroll in that state. More importantly, your share of service income that's apportioned to each state is going to be based on where your service providing employees are located. And you might have previously had them in states where it was also sourced based on markets, and now many of them might be in states that source based on income producing activity. I think a lot of states are going to get redlined for that. I think that companies that generate most of their income from the sale of services are going to limit the ability of employees to conduct that sort of activity in those states if they don't already have that footprint, because it can dramatically increase tax liability. You can be having your corporate income sourced to both the origin state and a destination state, leading to double taxation, and they're going to try to avoid that. There's nexus for state business taxes. Just about every state, all but two, told Bloomberg when they conducted their most recent survey that they would consider between 1 and 6 remote employees in a state as sufficient to have nexus attached for liability under the corporate income tax, other business taxes, including franchise taxes and license taxes that companies may not have to pay. So that will be something that companies are thinking through. There can be local tax liability. And on the individual side, you might have to fill out multiple tax forms to multiple states. You could have double taxation due to different sourcing rules like convenience rules, employment test rules. You could have double taxation due to a lack of relevant credits, especially at the local tax level. There's some potential that multiple states will believe that you are a resident and tax even your unearned income. And then if you are working frequently, a couple days a week, maybe in your office in one state and a couple days a week at home, you might have many days that are deemed to have been performed in two states, because any amount of work in a state, in most states, counts as a full day. So you could have days, if you have to calculate how many days did I work at home, how many days did I work at the office so that you can remit to both states, you could have many days that are taxed by both states. And the reason I bring this up as a revenue source question and an innovative thing is some states are getting innovative on how do we maximize the revenue from individuals who are working remotely or who perhaps used to work at an office here and are now working elsewhere. Other states are exploring the opposite. How do we make ourselves an attractive place for high income, remote capable employees? And these are opposite approaches. One is, basically, let's cling to the revenue we have now. There's a concern we could lose some of it. How do we avoid having that eliminated? The other is a more optimistic and I think a longer term approach. How do we provide businesses and individuals with the certainty, if you come here or if you allow your employee to come here, you're not going to be subject to a bunch of surprise taxes. You're not going to be subject to double taxation. But of course, there is tax revenue associated with being an attractive place for this activity. So we're starting to see some states looking at changing some of their nexus rules with regard to remote work. I think you're going to see more states adjusting their sourcing of service income. We're going to see more states making it easier to handle withholding. I'm hoping we'll see more states addressing reciprocity agreements. And all of these are very taxpayer-friendly measures, but I think for some states, at least, they have the potential to be revenue-generating measures as well, because we're entering into an era of really enhanced tax competition. We are going to see far more people be mobile than ever before. Far more businesses have mobility than ever before. You want to be a destination state. You don't want to be a state that sees people and businesses leaving. And making it too difficult to do remote work could be a reason why people, or especially businesses, leave. A lot of businesses want to provide this flexibility. And if they're in, say, one of the 6 states with a convenience rule, where your workers, regardless of where they are, owe taxes in your state based on that income being sourced to the office, as long as they basically spend even one day there. Go back to a meeting one day, trailing nexus attaches for the entire year, and you owe income taxes to 2 states, probably with no offsetting credit for an entire year. I mean, that's not going to work. If you really want to offer remote work flexibility for your employees, you won't let that happen. And I think a lot of small businesses are going to, figure out ways around that, which might mean moving their offices or creating secondary offices somewhere else. Larger businesses will relocate their staff, at least in their assignments, to offices, which means that you're not going to get them traveling to your state because they're now attached to the Houston office rather than the New York office. And states need to think this through. Right now, I think there's some fear, that we could lose people because of remote work. Let's do everything we can to make it difficult for them to leave and to try to hang on to that revenue for a little while, even if they do. I don't think that's the right long-term play. I think the right long-term play is, how do we make it as attractive as possible to be the destination or to maintain these individuals who have increased flexibility in the years ahead. So with that, I'll be glad to open it to any questions.